Well, let's go and bring in a man who's been paying close attention to this, particularly with his implications for the equity market. Martin Crabb joins us now from Shaw and Partners live here in the studio. Martin, it's a pretty big day for the market, up 1.6% or so heading into the close. It was already strong ahead of the RBA announcement, just a little cherry on top. What sparked this massive turnaround that we're seeing over the past couple of days?
Yeah, I think recognition that the sell-off that we saw last week in the Aussie market was particularly overdone. We saw a 5% sell-off on really no new news last week. The manufacturing data all came out a little bit weaker than expected for January, which was expected. But central banks just went really front foot. The Reserve Bank, as you guys were talking about, has gone very front foot today. They've given the Morrison government a little bit of leeway to take off some of the stimulus, which they're hinting at. So you want the Treasury and the central banks to be working in concert, and they seem to be. So even if Morrison's stepping away from the deficits, we've still got a central bank going absolutely hell for leather, as the Fed indicated as well. So yes, we expect some weakness in the economy. Yes, the labour market's still not where we need it to be, and yes, we're going all in. What did Janet Yellen say? Go big. We're going big. They're all going big. It's the opposite of what happened in the 80s. They killed the economy to get inflation out. They're now going to run this really, really red hot. So that sentiment, it's hard to be negative. And then you've got all the other stuff going on with people squeezing shorts and a whole bunch of hot money, going into silver and Bitcoin, and the spigots are going to stay open for years. So free money for everyone for as long as you like. Just go and buy assets and you'll do well. So that's kind of the sentiment that we're in. And obviously, big tech reporting tonight too, Scuddy. So we've got Alphabet, I think, is reporting tonight, and Amazon's reporting shortly. They're going to be big numbers too. Big numbers, big spend, big outlook. So, what's not to like?
Certainly, those shares rallied in anticipation of those results tonight. Look, our big tech, Afterpay, I had to go and take a double glance at this earlier today. It's currently up about 7.8% heading into the final price auction, 146.20.
Just another day in the market.
Just another day. Afterpay, what a story. That's a huge move for a company which is now an ASX top 20. An 8% move daily is...
it's like 3 billion or something, isn't it? So it's added 3 billion of market cap today. So how long will it take that company to make 3 billion in profit? I don't know, 100 years, 200 years?
You say that about Tesla, surely.
Yeah, but it's a stock that's not particularly well owned. There's not a big free float, and the people that like it just keep buying it. It's now 2.1% of the index, so index funds have to buy the thing as well. Similarly with Tesla going in the S&P 500, a whole bunch of funds that were never going to own that stock now have to own it. And at almost $1,000 a share, it's a meaningful part of the index. So yeah, there's more buyers than sellers, and the naysayers, the people who are short these stocks, are just getting squeezed all the time.
Well, we were sort of debating that the retail and construction, anything to do with housing, had a record run with COVID.
Yeah.
And we sort of thought maybe we're fully priced, maybe it's had its run. We had a couple of off days at the end of last week thinking, is it over?
Yeah.
But the RBA is telling us just keep going.
Yeah, that's exactly
Keep
right.
going.
So yeah, and the data that's coming through, whether it's the CoreLogic house data, which was out yesterday for January, saw another 1% move in house prices. I think auction volumes are up 20-30%. You've got construction spending's up 100%. Home lending's up 60% since May. There's $140 billion in cash deposits that weren't there in February in houses, another $100 billion in business. There's a lot of dry powder out there. Where's it going to go? It's not going to go to Fiji or Japanese ski fields like it normally does.
True.
It's going to stay in Australia. So housing's an obvious one, particularly detached housing. I think apartments may be a little bit different because the foreign buyer of those is not there, but certainly detached housing. And there's very few places to invest in the market. There's not a lot of home builders listed. They're quite small. So you've got a handful of domestic building material stocks that are running really hard. So you've got Reliance, you've got Boral, CSR, these stocks that are all running pretty hard, but they still don't look that expensive, particularly if their earnings are growing at 20 or 30%, they look like. So it's becoming a crowded trade. The other thing today is interesting is Dalian iron ore futures. They seem to have cracked a bit. They've moved down through that sort of key support level. So that's one to keep an eye on. You will see the iron ore stocks maybe give up a bit of ground. They were strong again today, I think, with a broader market, but that's certainly a development to watch.
Yeah, well spotted, Krabby. The most traded, actively traded daily contract down about 3.3% at 957.1 a tonne. Was testing 1,100 not all that long ago. Just keeping on that property space, but in a different realm. The online players that REA also have Domain Group. What do you like about them at the moment? Because I'm looking at what's going on. Turnover levels are definitely starting to go and pick up from very depressed levels last year.
Yeah.
Is that a thematic that you expect will continue as this housing market continues to rollick along?
Yeah, so the first stage is obviously people getting financing lined up. So we're seeing that in the credit numbers. So there's some credit numbers and finance numbers out yesterday, which showed that banking and lending volumes have certainly picked up. So that's the first stage. Then you've got people going to the whole seek and search and so forth. So with auction volumes picking up, but with things like Domain and REA, it's all about volume. So lots of people looking at houses, not a lot of stock on the market. So people are paying those premium prices to get the deeper ads, if you like, and get a larger audience. So they're very much being driven. So I think Nine Entertainment, which is Domain's largest shareholder now post the Fairfax acquisition, that was up 6% odd. I think REA was up 5%. But again, it comes back to this point that as an investor, you want to get exposure to what's going on. You can buy McGrath as a real estate agent. There's a couple of smaller ones listed too, but really you've got REA and Domain Group on the classified, and then a handful of building material stocks, and that's kind of it. And that's the biggest part of the Australian economy. It's like, a third of our wealth is tied up in housing, yet it's very few places to invest on the market. So it becomes very crowded, and people pay overs to get set.
But at least I prefer a stock market based on fundamentals as opposed to a short squeeze on Reddit.
Yeah.
I believe you also just added Stockland to your large cap stock. Is that a similar theme?
Yeah, and that's a way. How do we get exposure in a large cap? So we've got a large cap portfolio. It's only ASX 100, so it does limit the universe of stocks you can look at. So, okay, how do we get resi exposure? We've already got James Hardie as a US building materials play. But what about Australian detached housing? Again, it's difficult. So the two big developers that are listed are Stockland and Mirvac, and they both have diversified property portfolios that have also got office, which you probably don't want to go near because of the impact that coronavirus is going to have working from home, and also retail. We're not sure if brick and mortar retail is going to recover to anything like what it was pre-COVID because of e-commerce. But the bright spot of both Stockland and Mirvac's portfolio is resi. So Stockland's got 4,500 lots that they're settling each year, and they're going to get good prices for those and good volume. So that will be enough, we think, to offset any weakness in office and retail and probably drive that stock higher. So it's on a reasonably good yield. It's 5 and change as a yield, so that's really well supported. But it's really that delta on the housing side. That's why we added that stock in.
Tabcorp also out today, talking potentially divestments in the WIX, up 9% on the back of that news. What's your thoughts about what's happening there?
Yeah, it's one of those companies that certain assets that it has. I think it's wagering and media business is attracting some attention for maybe some PE people. So you look at, obviously Tabcorp is a conglomerate that's rolled up. Unitab, Tattersalls, all these other players, and there's some assets in there that are probably not particularly well run. And so I think what's happened with them is that they've had a tap on the shoulder from PE, said, look, we're happy to buy this part of your book and pay a higher price. It's a little bit like Link Market Services. It's a boring share registry, but they've got this thing called PEXA, which is the property exchange business, which people really want. It's not really being particularly valued well. It's like REA within News Corp. It's just not being valued well. So if a PE player can come along, pick that up at a reasonable discount, take it, run it well, and then spin it off, that's a good win for Tabcorp shareholders. So obviously there's a journo that picked up on that interest, so they had to come out to the market and clarify that they had a number of approaches, and people start doing the sum of the parts and say, actually Tabcorp's worth a lot more if you split it up, and that's what's happened today.
Just more broadly, has the Aussie dollar impacted your portfolio? Because there's a pullback today, just given the QE shock, but if the Aussie dollar looks like 80 cents by year end, how would you position for that?
Yeah, look, that's been a big concern for us and probably stopped us putting more money overseas. It's just, we are concerned that the Aussie, because it's commodity risk on currency and we're in a cyclical upswing, the Aussie dollar typically does very well. So you want to be hedged back or just avoid the US dollar. So if you look at the earnings breakdown of the market, earnings are expected to grow about 23% this year, and about 45% in resources, despite a higher dollar, because commodity prices are so strong. You then look at financials, mostly banks, that's also up about 23%, because we're getting the credit growth and we're also not getting bad and doubtful debt charges. If you go industrials ex financials, it's only 3, and a big reason for that is the cycling the higher dollar. If you look at the big stocks, CSL, Amcor, Brambles, they're all earning US dollars, so it's definitely a headwind. We think probably high 70s is where this thing settles. Obviously today with the RBA saying we're going to buy another $100 billion worth of bonds and flatten the yield curve, there's no interest rate differential support, and the iron ore futures coming to roll off, hence the weakness today. But I think we're broadly in an uptrend. So we're probably favouring cyclical stocks, domestically economy exposed stocks and banks, rather than the global growth financial stocks, which did very well last year. So the CSLs, ResMeds, they're going to struggle in this market.
Let's get to the local reporting season, just in its infancy at this stage, but a bit of a clunky segue. But you mentioned bad and doubtful debts. Credit Corp, top of the tree so far, 9.1% for the session. Pretty solid result there for the first half.
Yeah.
Any takeaways that you looked at?
Yeah, well, they guided higher. So they guided back in December some reasonably good numbers. So they buy PDLs, personal debt ledgers. So, you know, if you're a little bit late on your Telstra bill, Scuddy, and Telstra just don't want to chase you, they'll sell that bad and doubtful debt to Credit Corp, and they'll send some guy around to your house, knock on your door and say, Scuddy, time to pay up. So that's what they do. Now, they were very successful in that. When the market turned down dramatically in March, they were able to pick up some PDL, some personal debt ledgers at very good prices. And those the performance of those ledgers is coming quite well, because obviously there's a lot of government support, there's a lot of wage keeper, job keeper, these sorts of payments. So companies are doing relatively well. So they've guided to higher earnings. They're also saying they're going to buy more of these ledgers going forward. So they're really in the sweet spot. They did a big capital raise. They've got a really strong balance sheet, and they're out there buying these ledgers at very good prices. So that's upgraded. Very sharp part of the reporting season. They're one of the first guys to come out, and they've upgraded. And the other one was Centuria Industrial Property. So anyways, industrial property, I mean, everyone loves sheds at the moment because of e-commerce. So they, again, guided higher as well. So, you know, very early days, but 2 reasonably good results today.
Just to go finish off, we also saw Temple & Webster. Now, with a company with such high expectations, I don't think I've seen one in a long time. Failed to go and meet them, down around about 2% towards the close. Was off a lot more earlier today. When it comes to these COVID winners, have we got to the point now where the bar has reached that point where it is simply too hard to go and impress? Yeah,
I think a lot of very smart small cap managers, you know, killed the pig with these stocks last year. Whether it's them, Marley Spoon, there's a bunch of them that are pure online businesses that just absolutely flew. And, you know, everyone's fading them. Even if the numbers and the retail setup's still very positive, as you spoke about earlier, you know, lots of people are back at work, lots of people got stimulus checks, there's lots of money sitting in the sidelines. Retail as a group looks good. People are going, well, actually, aren't I better off being in JB Hi-Fi? I'm paying nowhere near the multiple for it. I don't need, you know, the sort of growth that the Kogans and Temple & Webster's had. So I'm not surprised that investors are fading that rally a little bit, because it's run too hard too fast.
Martin Kraft from Shaw and Partners, always fantastic to go and get your views on a Tuesday afternoon. We look forward to doing it again next week.
Thanks.